Hi, Mark Schwivens. Today I'd like to talk to you about comparing the stock market to the commercial real estate market. We got a lot of things going on in the world that represent change, and one of the big things is since COVID, we got the U.S. government printing a lot of money. If you look at the 10-year Treasury, it's up to 1.6%. So they're having to offer a higher yield for people to buy these bonds. And the end result of what's going on is there's a lot of people that are concerned the value of the dollar is going to diminish. And so people are coming to our firm regularly saying, should I be heavier in stocks or should I be heavier in real estate? Well, I'm a real estate person, so I'm not that big into the stock market, but I can share some fundamental facts. Right now, the stock market is trading at its third highest high. Stocks are valued on a price to earnings multiple. And that's just a lot of fancy talk. But the stock market peaked in 2000 from a price to earnings multiple. You probably all remember. That was right around the time of a pretty significant recession. It really peaked in 2009. We certainly weren't doing very well then. And right now, the price to earnings multiple of the S&P 500 has reached the third highest high at 41.54. So people are trying to figure out where to put their money, and in real estate, they confuse this topic by using the term cap rate. I think all of this is more noise than is needed, but let's just pretend that when you bought a public company, they sent you their share of net income. Now, we're not going to get into dividends and how all that works, but let's just pretend that you bought a stock and you got a piece of the income. At a PE ratio of 41.54, if you wanted to earn $100,000 a year, you'd have to buy $4.15 million worth of stock. If you wanted to make $100,000 a year in commercial real estate, we got a prevailing market cap rate of 7.2. To earn $100,000 in the commercial real estate market, you'd have to buy $1.38 million worth of real estate to get the same earnings. This number is really high. This number is starting to make a lot of people nervous. This number is creating a lot of comfort for a lot of people. And additionally, through tax savings, this number actually grows to 8.2% because depending on how you depreciate a property, you get tax losses equal to another 1% on your yield. You know, we add in the fact that 90% of Americans that have become millionaires have done it through commercial real estate. So if you're at all struggling with where you want to put your money, I'm just going to encourage you to look at this price to earnings multiple figure. Look at it on an S&P 500 graph on the internet over 90 years. You're going to see we're at a very high right now. And this is becoming a very predictable number. I don't know if this is of benefit to you or not, but I think it's interesting to compare these different investment vehicles to help you make a good decision. If you have any questions about this topic, please give me a call. Mark Schwivens. Thank you very much.